Today, we will talk about one of the very important institutions of modern times. The institution that I refer to is being considered to be highly influential in overall development of the human race. Can you guess what is it? Any idea? Now let me tell you what is it. This is the institution that's located just outside next to your door. Oh no, you need not to come out of your dwelling to find it. It is so close to you. Can you guess what I'm saying about? Pick up your smartphone and you can find it there. Now browse through it. Soon you will realize that you can ask for any service that it offers. So it's not at your doorsteps, rather, it's something that you can avail now right from your home anytime. I hope that by now you got some clarity on our today's topic. If your fingers are still crossed and you still do not have any clue, then let me not make you to wait any further. I basically refer to banking, commercial banking, right? The commercial banking that that exists in the today's time, right? So our today's agenda is to understand the commercial banking concept and the role or functions that these banks perform in our financial ecosystem. Let's begin with understanding what a bank is, and then we shall move to commercial banking, right? Can you figure out what's this image on your screen? Let's see one more. It's a little different. It's an Indian variant of the same thing that you saw previously. Everybody knows what it is called. This is our favorite childhood piggy bank, right? Most of us would have been made familiar to this in our childhood days, probably to inculcate saving habits in our lives. Although most of us would have used it to pool our money, but how did this small thing influence our lives? That's something that we would have hardly thought of ever. Now let's spend a few seconds to realize what a piggy bank does for us. Okay, a piggy bank is a wonderful idea to break down our bigger goals into small daily goals, and these big goals could be like buying a two-wheeler or a smartphone or going for a holiday. A piggy bank motivates us to pool small savings so that someday they help us to realize our big dreams that we otherwise feel unachievable because they would require large sums of money. Somehow, a piggy bank helps us to manage our savings through time. We keep on pouring money into a piggy bank for some time, and then is the time that we get excitement by finding a large savings in our hands. So a piggy bank is simply a medium or a link between us and our big goal. That's what exactly does a banking institution as well. So what is the fundamental difference between a piggy bank and a commercial bank? It's very simple. For instance, a piggy bank returns us what we pour into it, while as a commercial bank returns us a bit more than that. And what's that additional amount? That extra amount which a bank pays us on our savings is called interest amount. Now, where from that does that interest amount come to a bank? That's what somebody may like to know about, right? To understand that, we need to look at the business of a bank. Somebody has rightly said that the banker's business is to take the debts of other people to offer his own in exchange and thereby create money. Let's elaborate this statement a little bit. So, a bank accepts debts or deposits from others in the first case and then out of them makes its own debts. To pay us interest on the deposits we give them, they charge a slightly higher interest rate on the debts they extend to others than what they pay on the deposits or debts they owe to us. Right? Literally, this is how banks operate their business. Now we have learned what banks do. They simply accept deposits of money from public and in turn grant loans in the form of money back to them. They basically intermediate between two parties. And do you know what's their reward for that? The reward is the margin. And the margin is the rate of interest charged on loan assets minus the rate of interest paid on deposit liabilities. Imagine a loan that's made on 6% interest per annum out of the money raised by a deposit on 3% interest per annum. In this case, the bank earns a 3% difference for the job of intermediation. So this is how it works, right? This is not the only source of earnings for a bank. The banks also engage into other activities from where they earn. These could be like payment and remittance facilities, for instance. Think of how we remit our money to a friend or a merchant outside state or a country through a bank. Similarly, imagine how a bank helps us when we want to make a payment online, either through online banking or through a plastic debit or credit card. Today, there are many sources or activities from where a bank can actually make its earnings. Let's understand now how banks conduct financial intermediation. In simple, financial intermediation is stepping in between two parties or acting as a bridge between two people that may be interested to exchange money for future claims. Due to information asymmetry problem present in the financial markets, the two such people cannot do this transaction mutually without the help of a third party financial intermediary known in this case as the bank. Right? This is what gives rise to scope for banks to be there in the markets. Not just that alone. Banks are also very proficient entities that can do financial intermediation in the markets so efficiently. Right? They are very expert in doing that. But how do banks do financial intermediation? Or else, how do they do it that we as individuals cannot do the same thing ourselves? The answer is that they perform financial intermediation in two unique ways known as maturity transformation and risk transformation. First, we take maturity transformation. So let's see how does a bank do maturity transformation. Do you know banks generally prefer to have short-term demand deposits that are repayable on demand without any notes as its liabilities? But it could have also preference for long-term deposits that are not repayable on demand, right? They could be just like fixed deposits. But such fixed deposits are expensive than the short-term deposits. As against this, banks make loans mostly of longer maturities than the maturities of their deposits. This they do just to maximize or boost up their margins. How is that possible? The margin, as we know already, is the interest received on loans minus the interest paid on deposits. When a bank pays low on liabilities because on an average they have very short term maturity, or more simply they are demand deposits, and it earns high on its loans because they are on an average having longer maturity. This is how they can increase their margins. At the same time, such a combination creates a liquidity mismatch or maturity mismatch across their loan assets and deposit liabilities. So essentially, they have more risk now, and that's what increases the margins, right? Banks are very smart people because they accept short-term liabilities because they do not want to pay more, but give long-term loans instead because they want to earn more on them. Okay, this is how they transform short-term deposit liabilities into long-term loan assets. All right. Now I ask you a question. Can we do this? Not at all. This is something that only banks can do probably because they are very much proficient to do so. The second is risk transformation. And what's that? Before we get into this concept, let me ask you a question. And that's, do you know that deposits in banks are insured by the government? If you do not know, let me tell you that every deposit in a bank is insured up to a maximum of 5 lakh rupees, both on principal and interest amount held by him or her when a bank is declared bankrupt or when its license is cancelled by the regulators. This is probably the reason why we do not bother about a bank's financial health when we are giving our deposits to it. Now we understand that every bank depositor is insured, but on the contrary, there is no insurance, no such insurance to a bank when it extends loans to its clients, right? That time it has to face risks or else ask a borrower to arrange a guarantee or post some collateral so that risks could be minimized. Okay? But on many occasions, loans are given without any collateral security. So that's what leads to transformation of risks from accepting of deposits to making of loans by a bank. Therefore, on the liability side, risks are very low for a bank, probably because there is government insurance for deposits. But when we look at the asset side, the risks are comparatively higher. So that's what risk transformation is, right? Again, this is something that only banks are proficient at doing, and we as individuals won't be able to do at all. With all this discussion, we may now be able to frame a better definition of banking from what we have learned so far. Okay? Now we can say that the banking is the accepting for the purpose of lending or investment deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft, and order or otherwise. This is the functional definition of banking because it highlights the various functions that a bank performs in the market. This definition also reveals clearly how banks engage into maturity mismatch. If you look carefully at the contents of this definition, you can easily figure out how accepting for the purpose of lending or investment deposits of money from public, repayable on demand, right? So deposits that are repayable on demand are used to finance lending and investment that are generally long term in nature. So this is how the maturity mismatch is actually created in the banking business. These are the different types of banks that exist in India. Our focus today is on understanding of commercial bank and what functions such banks perform in the market. But let's look at different types of banks very briefly. Cooperative banks are meant for rural areas where they offer banking services to the people in far-flung or rural areas. These banks are governed by the Cooperatives Act. The cooperative banks operate in such areas where commercial banks generally have no or less footprints, right? Then there are development banks. Development banks are different from commercial banks in a sense that they are not profit oriented, as are commercial banks. The development banks are generally sponsored by the governments and their motive is development. Then we have investment banks, and these banks are very much proficient to operate in capital markets and help investors and issuing companies to enter into capital raising deals. Right? Then there are land development banks, and these are the banks that are specialized banks, and their job is to lend money for the development of land. So these are the different types of banks that operate in India. Now let's see what scheduled bank and non-scheduled banks are. Who are scheduled banks and what privilege do they have? Right? The scheduled banks are the banks that have paid up capital and collected funds equal to or above 5 lakh rupees. Such banks are listed in the second schedule of the Reserve Bank of India Act of 1934. For instance, all public, private sector banks and foreign banks are scheduled banks. Now, what kind of privilege do scheduled banks enjoy? The scheduled banks are eligible to take loans from RBI whenever they require funds, and they can also avail membership in the clearing house. Opposite to this, non-scheduled banks, that is the banks that do not fall in the second schedule of Reserve Bank of India Act of 1934. These banks enjoy only limited privileges from the Reserve Bank of India. These banks are allowed to avail credit facilities from RBI only in the event of some abnormal circumstances and not otherwise. So that was what are scheduled banks and non-scheduled banks. Then we move further on today's topic to see what are the functions of commercial banks. On broad basis, banks can have four functions. What are those functions? Those functions are listed on your screen. They include deposit function, credit function, agency function, and general utility functions. Under deposit function, a commercial bank accepts various kinds of deposits from the public. Then it performs credit function, under which the deposit funds are given away to others as loans. Then we have agency function. The agency function means that a commercial bank acts as an agent on behalf of its clients and then does a lot of activities for them. For instance, we go to a bank and ask it to remit or pay certain amount of money on our behalf to any other person whom we may be interested in paying it. Right? Just imagine paying your fee online or making a payment for some online shopping. In this case, the bank acts as our agent in paying money on our behalf, right? This may not be possible otherwise without engaging a bank, because either our beneficiary to whom we would like to have payment being made may be located at a faraway place, or else we may not be willing to make payment in direct cash, right? Now, there can be so many other instances where banks act as our agents and carry out agency function on our behalf, right? This is how a bank performs agency function. Then all other functions that a commercial bank performs are clubbed under general utility functions. Now we will examine each of these commercial bank functions in more detail. First, we look at deposit function. The commercial banks offer us a wide variety of denominations, interest rates, and maturities to choose from in case of deposits. For example, we can have deposits from them where there is no restriction on how much amount we can deposit literally, right? We can deposit any amount from rupee 1 to hundreds of lakhs of rupees. There are deposits that suit businesses and deposits that are designed for households. Similarly, banks offer us deposits where we have to follow a certain minimum amount of denomination. For example, term deposits where we are encouraged to deposit say a minimum of 100 rupees and thereafter in multiples of that amount. Apart from this, banks also provide us with a variety of deposit facilities such deposits that pay no interest but offer lot of liquidity to such deposits that pay some interest as well as offer some limited liquidity. As a rule, interest rates would be higher if we deposit for longer period than shorter periods of time. Next important thing that we know already is that bank deposits are insured by the government. So in case of bank deposits, risk of losing money is almost non-existent, right? Finally, all bank deposits come to us with ready liquidity. That's except in few cases we can withdraw money from our deposits anytime and even without giving any prior notes of withdrawal to the bank. Then what are the deposit types? On generic basis, all deposits that we can have from banks can be grouped into two categories. That's demand deposits and time deposits. Now someone can argue that there is huge variety of deposits nowadays being offered by banks. To this we can say that deposits may have any name, but they would always belong to either of these two categories. Or else a deposit may have been designed by picking up few features from both of these two categories, right? Now, what is the difference between demand and time deposits? You can find that on your screen. For instance, demand deposits have flexibility in withdrawal. Thus, they can be retrieved anytime, but in lieu of this feature, they enjoy very low interest yield. This must be kept in mind about the demand deposits. Demand deposits can enjoy check drawing facility, or in today's times it can have a debit card facility which can be used just like checks to make payment to others electronically, right? Contrast to demand deposits is time deposits. Their features are almost opposite. For example, a depositor in time deposits doesn't enjoy frequent withdrawals, but in lieu of this sacrifice, such deposits earn interest more than what banks pay on their demand depositors, right? So there isn't any time liquidity option for time deposits like demand deposits. They can be withdrawn normally only upon maturity. So that was a distinction between demand deposits and time deposits. These are the various types of depositors from whom banks accept deposits. The largest segment to which commercial banks cater with deposit function is households. These include people like you and me, right? Then there are other customers like governments, fellow banks, and corporations. The second function that commercial banks perform is the credit function, and that's granting of loans and advances back to people and institutions or businesses and companies. Why do people prefer to take loans from banks? This is because they offer us a convenient choice, and not only that, the transaction costs on bank loans are also low compared to other options of finance that we may be having, right? Moreover, with a bank, we can customize transactions that we do with banks. Moreover, with a bank, we can customize a transaction because all transactions that we do with banks are over the counter or bilateral, or more simply, they are direct between a borrower and a bank. If that is the case, then there is a great scope of customization of the transaction to make them more specific to needs of the two parties. One more advantage of taking credit from banks is that they give us a retail option. What's that retail option? The retail option is that they can give us a loan considering our specific need. For example, some of us may be interested in buying a computer or a two-wheeler. Some others may need just the money without sharing with banks how they might spend that money later on, right? For them, banks have the credit cards. So literally, they can finance us for any activity provided it's not illegal, right? That's what is called convenience, and it is provided to us by banks in many ways, which includes option of retail loans as well. Now let's see in how many ways banks can offer us loans. On your screen, you can see there's a lot of choice. Again, on generic basis, the types of loans that are made by banks include demand loans, cash credits, overdrafts, bill discounting, retail consumer and mortgage loans, right? All other loans except term loans, consumer retail and mortgage loans are demand loans. That's they are repayable on demand anytime. Well, term loans and consumer retail and mortgage loans do have a specific or a specified maturity. Then we examine general utility function performed by the commercial banks. Now under this category we have safe custody services like locker facilities, etc. Now what for are the locker facilities? In bank lockers we generally keep our valuables like our jewelry, documents of the property, etc. The locker facilities, etc. are the services under which banks enter into fiduciary agreements with their clients. In simple, this involves a relationship of trust between a banker and his client, right? Another example of fiduciary services is when we hand over a sum of money to a bank for payment to a third party on our behalf. This is also called remittance service or facility. Under this category, banks traditionally offer services like demand drafts or DDs, mail transfers or MTs, and traveler's checks. Today, with the advent of information technology, banks offer us newer products like point of sale facilities, online banking, NEFT, and RTGS. These services are considered more efficient than the traditional modes of remittance that we had already. Well, how is that? How is it that? Right? This is because the traditional modes of remittances are deferred. That is, they involve a time lag between when we hand over money to a bank and when that money is actually received by our beneficiary. However, this is not the case with modern electronic modes. They are real time. Thus, they do not cause much time lag. For this nature, we refer them as wire transfers. Right? The money that we would like to remit essentially gets credited or paid to the other party almost immediately. So that was about the role played by the commercial banks under general utility functions category. The banks can offer remittances of funds efficiently because of two reasons. Number one reason is that there is often a geographical gap between two parties that want to exchange money for something, right? In other words, the place of the remitter and the beneficiary is geographically different. This is why we would need to engage an intermediary to make a payment or remittance in such a condition, right? The second reason is that banks, because of their presence everywhere, need not to move money physically for the sake of effecting a remittance. This reason makes it possible for banks to pass on money from one individual to other individual so effectively without consuming much time that otherwise may be consumed if we were physically to move money from one location to the other location. The general utility functions can also be performed by banks in other ways as well. For example, banks render general utility functions while issuing and handling of letters of credit, handling of government pension services, and other government transactions. Think of the moment when we make payment of utility bills like electricity bills through banks. So this is how banks render general utility functions for us, right? Finally, we have agencies function. Now on your screen, you can see various instances where commercial banks offer agency services, right? Technically speaking, whenever a bank becomes agent of its client to handle any of its client services, those times a bank is actually into its agency function. For instance, payment and collection of checks on behalf of their clients, collection of collection or handling of bills, execution of standing instructions like stopping payment on a check, and other trustee services. All of these transactions are the instances where banks act as agents for their customers and thereby give rise to agency functions. With this, we conclude today's discussion on commercial banks and their functions.